Aloha, this is Paul Brewbaker of TZ Economics, presenting a 2024 kind of a wrap up using material that I've developed over the year uh, for other presentations that I'm consolidating here to provide post-pandemic perspective on the economy of Hawaii. And let me just jump right into the PowerPoint slides. If you'd like a copy of the slides, contact me, Paul Brewbaker at tzeconomics.com. I'd like to acknowledge the support of the Hawaii Economic Association and CFA Hawaii, who sponsored some of this work, but who are not responsible for the contents and the views which solely are mine. And I've divided this into 4 parts so that it won't be any too long for any one segment. And each of those will be posted separately. And if you want copies of the slides, again, reach out via email to Paul Brewbaker at tzeconomics.com. TZ Economics, all one word. Paul Brewbaker, no dots. Paul Brewbaker at tzeconomics.com. Without further ado, let's jump into this and let's see, can I get rid of this window at the top? There we go. Some post-pandemic Hawaii economic topics, part 1. I want to talk about, by the way, this is always a work in progress. I'm not sure these are all in the first part of the presentation. I think some of this is in part 2, but we'll talk about the recent inflation statistics and monetary policy pivot this fall, consequences of tight labor markets and how that influenced the disinflation and soft landing that we've enjoyed as in 1994 and the mid 1990s. And then we'll move on to talk a little more about resilience. I do want to start with some background information on Hawaii's population and demographic situation. As you may be aware, Honolulu has been losing population essentially continuously since 2016. There are some revisions to those intercensal estimates pending, but that's caused the overall state numbers to have been now in decline, both pre and post-pandemic, for the better part of 8 years. So not a short-term thing. This is the new normal for Hawaii. On net, people are not moving to Hawaii, and indeed, on net, people are moving away from Hawaii. And those out migration flows, net domestic out migration, are specifically are offsetting, overwhelming other sources of population growth, net international in migration, which has been shrinking, and natural increased births, less deaths, which are moving in the opposite direction for long-term decline in fertility, and then the aging of the baby boomer cohort, which is showing up in increasing absolute numbers of deaths from old age, essentially. Just to point out, this is not the first time Hawaii or portions of Hawaii have lost population over the last couple decades. Of course, the 19th century notoriously was a period of population loss. But for the neighbor islands collectively, the mid 20th century also was a period of extended population decline. And I'm not sure either people know that or remember it because they weren't around. But a lot of people seem to be thinking, hopefully, about neighbor island population decline. And yeah, the mid 20th century was not a great time for the neighbor islands. Mechanization of plantation agriculture exports meant that people were leaving for 40 years. That changed in the early statehood period, but be careful what you wish for is kind of the point here. If you look at the state of Hawaii's population projections for the neighbor islands, they've been projecting population growth for some time. In each of the last 2 semi-annual population forecast estimates that the states published, the impression one gets thinking about those forecasts, and you can see the one from 2018 highlighted the pukas there with the yellow backdrop, aligning them. And then, and these are population numbers on a log scale, of course. The more recent population projections from this summer, um, I don't know, wishful thinking. We'll see. Just because there's a trend in the data that looks like an inverted U doesn't mean that it has to continue. But I guess the question would be, why would you expect it not to? Why would the neighbor island population projections be any different from what the state dominated by the 75% of the population comprising Honolulu's population of the island of Hawaii? Why would that be any different under the shared economic circumstances that the four county economies and all the Hawaiian Islands as a whole face collectively? Labor force participation has been rising nationwide in the post-pandemic period, but has not been increasing in Hawaii. In fact, it's been continuing a long-term decline. Now, that longer-term decline is present in the national data as well because of the aforementioned aging of the population, generally smaller, younger cohorts than the large boomer cohort that are now entering the final quarters or thirds of their natural lives. With the decrease in labor force participation in Hawaii, the employment to population ratio has been declining. And I think it's important to note that these were not just declining pre-pandemic, but have continued to decline after recovering to downward trend post-pandemic. Indeed, employment generally, whether measured in terms of persons employed from household surveys or the non-agricultural payroll data that come from the establishment surveys, the job count, occupied jobs, both of those numbers are down substantively, about 30,000 persons, about 30,000 jobs since either immediately before the pandemic or at the time of the benchmarking of the employment data, where you see a break there in the data between 2016 and 2017. Clearly, the transitory impact of the pandemic itself, which generated 20 to 25% unemployment rates statewide, has passed, and Hawaii's been at 3% unemployment now for several years. So full employment, but at lower absolute numbers, maybe down 5% from the totals 5, 7, or 8 years ago, approaching 10 years. So we're talking about a decade of decline and approaching a decade as we enter the mid 2020s of population and employment decline. And in the longer term picture, these are the household survey data. Persons employed grew at a relatively rapid rate before the 1990s. After the Japan bubble slowed down, the subprime bubble created a temporary surge in the early 2000s. And then in the 2010s, Hawaii was back on track, but something's changed since the re-benchmarking, and it's not statistics. It's something going on in the underlying economy, which is not just detached Hawaii from pre-pandemic trend, but or early to mid 2010s trend, but is moving it nearly orthogonally off, right down an off ramp to the right there. I mentioned earlier the age cohort distribution of the population of Hawaii is tilted to the upper age groups, and you can see, for example, that there are more persons in every 5-year age cohort from the age of 25 to 75 for females and 70 for males, I think is the statistic, as if I recall correctly. 74 and 69. There are more persons in these middle and older age cohorts than there are persons in the age 15 to 24 cohort. So that is to say that the younger cohorts that are entering the workforce in Hawaii, in a state where net domestic outmigration has been negative for 6, 7 years or more, those prospective workforce entrants are smaller in absolute number than any of their older age cohort peers, and in particular, as older persons leave the workforce, will not be numerically sufficient to replace the workforce. So we have a old age dependency ratio that is relatively high, and here these are data that are about to be revised, or that we keep getting told by the Census Bureau that they're going to be revised. But you can see the pattern up through the decennial census data in 2020 throughout the 20 teens of diminished births, annual births, increasing deaths, again, part of the aging phenomenon generally, a decrease in international in-migration, net in-migration associated with the Trump administration, the first Trump administration, presumably no uh, um, improvement in net international migration, unless you think less is more, in a second Trump administration. And this dramatic and long-standing net domestic, net resident out migration, where more residents are leaving Hawaii than are moving to Hawaii, which again, subject to revision. The intercensus estimates for the 20 teens all have to be revised. But even in the 2020 population estimates, you're seeing essentially the same patterns, with the exception of that international in-migration surge or surgelet, which accompanied um, the Biden administration supplanting the first Trump administration's policies. Just a point about the brain drain, these are older data from the mid-20 teens, but it's important to maybe question certain myths about who it is that's moving. In general, persons that move have higher educational attainment than persons who don't move. So when people talk about the brain drain, they usually mean that all the smart kids are leaving Hawaii, leaving all us Nambradas in the islands, when in fact, domestic immigrants, right, U.S. residents moving to Hawaii are the most highly educated of any of these groups. The domestic out migrants from Hawaii are more highly educated, but not as highly educated as the immigrants. And in fact, the international immigrants also are more highly educated than residents who don't move. So the smart kids are moving, but it's not clear that on net the smart kids are leaving. And I think it's important to remember that in an information and services producing economy where higher educational attainment is associated with higher productivity and higher compensation, and particularly in a state where it's not clear that our natural resource endowment, other than the human capital endowment, allows us to do that much in terms of economic development. So let's move on to the inflation story. Inflation in Hawaii peaked 2 years ago, 2.5 years ago, actually. So it's time to get over it, right? Deal with it. She's not coming back. And we did have a surge in first half 2024 inflation that's essentially associated with FEMA paying way too high rents on Maui because the wildfires destroyed 2,000 housing units, and Maui County won't let anybody build 2,000 housing units, at least not yet. And it's been a year or 14 months. The Fed's obviously not waiting for Hawaii, having brought the inflation rate back down. The Fed has moved to a more accommodative monetary policy, normalizing the target rate, the overnight Fed funds rate, and switching to quantitative tightening, or letting assets roll off its balance sheet without replacement on a planned trajectory. Coming up in the next year, a reexamination of the Fed's statement of longer run goals and monetary policy strategy, which they sort of take up every 5 years or so. And so we should be looking for some clarity on questions that have been left on the side, like, For example, are we going to move to, is the Fed going to move to a more rules-based or algorithmic approach to quantitative easing or quantitative tightening? Just an example. So let's look at the inflation data. The pandemic itself, pandemic recovery in particular, by disrupting global supply chains, and because certain areas of production had to shut down completely, anything that couldn't be done at home at the time of pandemic onset had to shut down at least temporarily. And when those supply chains were reestablished in the recovery that accompanied vaccination, widespread vaccination in 2021 and subsequently, the contribution of demand and supply factors, demand factors stemming largely from fiscal and monetary policy stimuli, and indeed federal fiscal stimuli that in retrospect, were probably a little too large, but of course at the time were thought better to, be too large than be too small, as they were in 2009 in the Great Recession, leaving you with a jobless recovery for an extended period. But that did contribute to the inflation. Maybe, I don't know, 40% demand, 40% supply, and then, an ambiguous crossover area where these factors are difficult to sort out. The supply side factors were still important recently, but obviously the Fed was focused on tamping down the excess aggregate demand factors, and they successfully have brought the headline PCE, personal consumption expenditure, chain type price index measure of inflation to 2.1% as recently as September. These are slightly older data, and you can see that moving back towards a more normal pattern where goods inflation is actually negative on trend and services inflation is positive. The Fed has succeeded in what it set out to achieve, even if at the front end there was a sense that it might have moved too slowly. And you can look up these data yourself. I just did this an hour ago. You can just pull the chart right off the Fred website, and there's that 2.1% number that I referred to earlier. By the way, if you get the slides, all the links are in the bottom of each slide. The concern now is with expectations of inflation, particularly given the recent Trump electoral victory, and for the first time in 20 years, a Republican majority of the popular vote. Inflation expectations. So here we're looking at the difference between nominal Treasury yields and Treasury yields on Treasury inflation protected securities, TIPS yields. So presumably the difference between the nominal and the real yield up to a small inflation risk premium is the bond market's expectation of inflation at different maturities. So we've got a term structure of expected inflation at the 5, 7, 10, 20, and 30-year maturity. And in the way I've illustrated here, the 10-year is the heavy black line, and the 5-year is the heaviest of the blue lines. And you can sort of, think about as in 2022, where the 5-year expectation of inflation was up over 3%, the 10-year was just under 3%. That inversion, so to speak, tells you that the market's expectation is the inflation is going to be more front-ended than back-ended, right? Going to be more in the next 5 years than in the next 10 years. And what I want to, even though inflation expectations came back down and right into the Fed's 2.5% range, that is to say, the Fed's goal is 2% PCE inflation. But the way most people think about inflation is in terms of the consumer price index. So a 2% Fed target would be a 2.5% inflation goal, and I CPI inflation goal, and I put in the 2.5% CPI sort of benchmark there for you to think about. Expectations come down into the 2 to 2.5% range, and then more recently, as we saw polling this summer after President Biden withdrew from his reelection campaign and Vice President Harris stepped into the breach, we got to see the polling moving towards Trump. We're going to see Bitcoin prices rebound. We began to see these inflation expectations drift up a little bit. And I caution you, the last data point here is from the first week of November. And if you followed the bond market last week, the election was on Tuesday. The results were announced by Wednesday, and Vice President Harris's concession at that time, and a lot of bond market volatility Wednesday and Thursday. So let me take out the November guess from the first week because it almost certainly is wrong, and let's look more closely what was happening prior to the election. So prior to the election, you see this initiation over a period of 4 or 5 months of renewed concern about inflation on the 10-year horizon. You can see that the 10-year inflation expectation pulling away from the 5-year rate. So unlike in 2022, when the concern about inflation was more front-loaded, now the concern is more back-loaded because of the expectation that a Trump administration would be more likely to create less likely to reduce federal budget deficits and more likely to engage in policy making, which leads to larger federal indebtedness than would otherwise be the case. So that even though putatively conservative administration elect made certain assertions about what they were going to do, the bond vigilantes are looking through this and looking at the prospect of higher deficits and the risks of higher inflation, particularly as you move further down the road. And so we'll see where this goes. Largely, inflation expectations remain well anchored, but this very important dynamic of the last several months is worth looking at. In Hawaii, our inflation basically followed what happened nationwide and worldwide. It was a worldwide phenomenon. The pandemic was worldwide. The supply chain breakdown was global, and so the inflation was worldwide. The inflation decreased as quickly as it increased, so it went up for a year and a half, it came down for a year and a half, and then in Hawaii, and then it sort of took a while to settle nationwide, but you can see, partly because of the continued supply chain factors that we saw attribution to in an earlier slide. In Hawaii in particular, the big supply chain breakdown was in housing on Maui because of the wildfires and the county's refusal or lack of imagination or whatever it was to allow 2,000 replacement homes simply to be built anywhere. It doesn't matter where, the whole island didn't burn down. But the fact that those 2,000 homes in Lahaina were compelled to wait until toxic waste remediation could be completed, and then now, even a year later, are still being waited for people to figure out what's going to happen to Lahaina, as if people whose private property is at stake care what other people think. Even now, the amount of home building is like trivial. You can look that up too, by the way. Just look up the building permit numbers. We'll do that in, I think, part 4 of this presentation. But because of the shortage of housing and FEMA providing a rental housing support for displaced households, wildfire displaced households, and rents running to up to $10,000 a month for some of the victims. You can see the inflation measure in Hawaii. It's basically all in the housing component, which is all being driven by the rental component and is all being driven by Maui. So you can see how that ran up. And in the last couple of measures, I think through September, had started coming down. So right, the rents go up and then they stay there. So the inflation goes up and then comes back down, right? The rents stay up, but the inflation, once they stay there, the inflation keeps coming down. just like the price of eggs in the supermarket, stop whining about it. So that's where we're at in Hawaii. The Fed's policy, and by the way, that's avian flu. Okay, just saying. Uh, the egg thing. No houses, that's on Maui County, but expensive eggs, that's on avian flu. And avian flu is everywhere, by the way. So, like with the freaking feral chickens in Kailua. So here's the term structure of nominal Treasury yields, and that period of Fed tightening, which has now, since September, um, switched direction towards easing and moving at a relatively rapid pace at the outset with the 50 basis point uh, target rate cut, target Fed funds overnight interbank interest rate decrease another 25 basis points last week when the Fed met. The expectation of further rate decreases as we move into the December Fed meeting and out into January when we'll have new forecasts, etc. The path laid out in the September Fed forecast for the overnight rate is shown here in the blue dashed line. That's the median of the, is it 19 members? Are they at full strength now? 12 Federal Reserve district bank presidents and their staffs. I guess that's 17, right? 5 governors, 12 district bank presidents, so 17 members. And the range of forecasts shown in the wider blue, light blue area with a median median projection of the so-called neutral rate, an overnight rate consistent with potential GDP growth and full employment, equilibrium, a 3% neutral overnight rate, which presumably would not be inconsistent with a long-term Treasury yield in the neighborhood of 3.5% to 4%. And we've been almost to 4%, although things backed up the last few weeks, of course, with those inflation expectations we were just looking at. But that, the range for the 10-year yield, sort of gyrating, trying to find its level in the last year or so from 4 to 4, broadly from 4 to 4.5%, awaiting Fed confirmation of their policy pivot, is now being tussled between the two, right? The risk of potentially higher inflation, such as that may or may not be, and then the more likely, the more probable, given the forward guidance that we get from the Fed, expectation of a lower overnight rate handle. So the front end of the yield curve moves down, and unless you really expect inflation out in the future to be a problem, which doesn't really seem to be that big a deal, then the term structure should settle accordingly. Taking a closer look at the Fed September forecast, you can see that the central tendency of committee members' projections was fairly narrowly arranged around the median expectation, although in the out years 2026 and 2027, you can see that you can basically infer the skew as the range goes all the way up to 3.75, I think it is, and of course down to 2.5 by some members. As far as where we end up at the end of this year, the distribution is illustrated on the right side of the page. So you see, we're headed for the low to mid 4% range for the overnight rate. We're at, what are we at now? 450, and so a shot at 425, let's say, by year end, with more to come in the Fed's own expectation. And I've also illustrated the National Association for Business Economics outlook, although they're behind the curve. They did their forecast before the last Fed meeting. On the quantitative part of the Fed's policy mix, the Fed's balance sheet has been shrinking for a couple of years, right? So after the onset of the financial crisis, Ben Bernanke sort of ingeniously came up with this idea, or his team came up with this idea of injecting liquidity into the system at a time of great uncertainty, great financial systemic uncertainty. So, right, confidence is liquidity. The Fed injected liquidity, uh, switching our banking system from one in which reserve deposits were essentially nil, initiating payment of interest on reserves so that there's no opportunity cost to holding them in reserve as opposed to acquiring funds, overnight liquidity in the interbank market, which had broken down after Lehman Brothers. And that deep pool of reserves continues to exist on the liability side of the Fed's balance sheet, about 3.25 trillion in bank reserves. So that's backstopping the banking system. That's their own bank reserves. It's like your checking account at their bank, right? The banks have a checking account at the Fed. And in several rounds of quantitative easing, the Fed under Bernanke and subsequently Janet Yellen um, engaged in purchases of Treasury and mortgage-backed securities, which are important in keeping the long end of the right, bid up the bond prices and keep the long-term interest rates lower, and provide liquidity directly in support of the secondary market for mortgage originations and the low mortgage rates we had all through the 20 teens. When the financial crisis, I'm sorry, when the pandemic came only shortly after the Fed began to normalize its balance sheet late in the 20 teens decade. Once again, the Fed stepped in with a massive easing, and by 2022 was in a position with the Fed tightening and rise in interest rates to reverse that, to move to quantitative tightening. Did I say quantitative easing before? So the tightening path continues. You can see that the use of reverse repos, which is like a credit facility essentially that the Fed has with the commercial banking system, has diminished. So we're moving towards normalization at a relatively steady clip at this point. And in a sense, the Fed is sort of recharging its batteries. I just want to make a quick comment about why mortgage rates persist at such a high level. Uh, so generally, if you think of the 10-year note yield as the risk-free benchmark, historically, the 30-year fixed rate mortgage average for the US, published by Freddie Mac, has run about 175 basis points over, the 10-year yield. So if you think that the neutral overnight rate is 3% and the neutral 10-year yield is 4%, then 4 plus 175 would give you 5.75 neutral 30-year fixed rate mortgage. If you think the neutral rate overnight is 3%, 10-year is 3.5, then add 1.75 to that. And what do you got? 525? Am I getting that right? So you see where we're going here. There's, maybe a five handle in the future. But what's happened in the last couple of years is that because interest rates went up so sharply, the first more than they have in the lives of the population of half of America, right? Nothing like this has happened in 40 years. The spread between the mortgage rates and the risk-free benchmark widened out significantly, and I have a little cheat sheet on the 4 reasons why that's true, but I won't go through them in detail. Technically, there's a difference between the primary rate that the borrower is getting and the secondary rate that the mortgage-backed securities are going to yield, depending on, there's a timing differential there and which way interest rates are moving. There's been an inversion in the yield curve. So it turns out the average life of a mortgage is 7 years rather than 10 years. And in the last few years, the 7 years has been higher than the 10-year yield. So that's added a little premium. But most importantly, these two other factors, essentially prepayment risk, right? So you go from a 3% mortgage rate to something like 7%. And the odds of it going back to 5, as I've just suggested, are pretty good. So anything originating at 7%, you have to know as soon as rates move back down, the borrower is going to exercise her option to put that note back to the bank and call a new one at the lower interest rate. And because of that, because of that prepayment risk, there's a risk premium that shows up there, which I've labeled here a call premium, right? So that what you have to pay in order to exercise your call option, and then a technical and option adjusted spread that comes from the fact that the Fed through quantitative tightening, right? If you look at these reduced purchases of mortgage-backed securities now, the Fed is providing less support for the long end, for the long-term interest rates, broadly, but for mortgage uh, secondary markets in particular, right? There's liquidity that was flowing into those markets that's no longer there. So you put all these things together, that spread has been uh, relatively high, has been very stubborn, is only slowly coming down. And so it's one of the ways these things work out when you've had a really large 525 basis point increase in the overnight rate. The entire term structure gets ratcheted around in a very short period, and then the Fed reverses that and goes in the other direction. There's a lot of uncertainty basically, and the risks that lenders need to be compensated in order to make loans, those widen out. And here you can see in the historical record how large a premium is there. And what's that red line? I can't remember. Oh, okay. This is a measure of this call premium over over the last 50 years in basis points. So we're at 235 basis points down from what was that? I don't know, 275 or something like that. And the historical average is 175 basis points. Will we get back there? Maybe in another year or two, maybe sooner. But that's where we're supposed to be going. And it's that resistance, it's that friction that's preventing, that's actually making a big contribution to, the perception of inaffordability in the housing market. But either way, we had a soft landing, and uh, successful execution of inflationary monetary policy without a recession. Notwithstanding geopolitical risks and geophysical risks, hurricanes and tropical cyclonic events and wildfires and whatnot. So it's all good. That was it, and here we are, and that's the end of part one. So see ya in part two. Mahalo.